Okay, guys, so whenever I do a Q&A, I get a lot of questions regarding the daily time frame, what to target, what PDAs to use, what direction to look for, and so on. So let's quickly talk about it because I know that a lot of you guys are trading and looking for classic buy days and classic sell days. So every Monday morning, I like to start from zero. I clean all my charts and start from a blank page. One of the most common mistakes is having your charts really cluttered with a lot of drawings, with a lot of PDAs and levels. This is a very common misconception that especially applies for ICT traders who think that the more notations, levels, PDAs you have on your charts, the better you know what you are looking for. Old levels and old PDAs, old annotations and stuff like that, a lot of the time will just simply misguide you. What you actually want in your trading is a clear page so you can see what you are looking for that day, for the next 3 days, and for that week. What you actually want is a clear and not confusing chart. And in my personal opinion, that's the goal no matter what style you're trading. No matter if you are a CMC trader, ICT trader, or you are just trading price action, it doesn't matter. The cleaner the chart, the better. What I'm saying that is every trading day we start on a clean lower time frame chart. The same way every week we start with a clean higher time frame chart. What we have right here is a simple market maker sell model. You can see that we are pushing away, we are pushing to the downside from a weekly rejection block, weekly PBA. So daily time frame bearish order flow is still very much in control right here. You can see that price stopped just a few pips above this 1.06 level, and price is reacting higher right now from this daily fair value gap right here. It's pushing up to opposing PDA, which is another fair value gap. So what are our immediate thoughts about this current situation? Our immediate thoughts are that we are still in a clear bearish delivery right here, pushing away from a weekly PDA. Our daily market maker sell model just got completed right here. This means that we don't have to overcomplicate everything, and we are trading still inside of this range right here. This means that everything past this vertical line right here doesn't really matter to us because we are already trading inside of this internal range right here. So everything that matters are the bearish opposing PDAs. Once price reached into this bearish fair value gap right here, we need to look at this low and think where it stopped. It stopped at Bailey fair value gap. However, it didn't reach the consequent encroachment as well as it didn't tap into our level. This doesn't mean that we can't see a deeper pullback here. But at first, our logic, once price got to this bearish fair value gap right here, was to see a simple institutional entry order drill type of an entry right here, pushing away from this bearish fair value gap. So this is how our whole thinking process goes. Once we reached into this bullish fair value gap right here, we can simply go both ways. We can go sideways, we can go lower and reach our level, drop in consequent encroachment of this fair value gap, as well as we can just consolidate and eventually climb deeper into the bearish PDA. Now, once price pushed higher and we reached this PDA right here, from here, as mentioned, we are start automatically looking for bearish pressure on the lower timeframes again, because what we want is higher timeframes get in sync with the lower timeframes. This is what we call lower timeframe, higher timeframe alignment. And that's the case, we don't want to mess around and we put our main focus on the downside if the lower timeframes align with our daily bearish vision. However, if we don't see lower timeframes align with our daily vision, and for example, price either is just slowly climbing higher, deeper into the daily range, or it goes sideways right here, what we do is we simply wait until price on the lower timeframes gives strong high that we will start to trade away from, or the complete opposite happens and price gives a sharp 31st lesson, as we call in my group, low, where it simply isolates this low right here. What this means is that simply from here, we start to push away from this type of a low, which we can see right here. And from there, we start looking for lower time frame order flow towards the higher daily levels. And the first one being this one right here. Second being high of the fair value gap. You see how price reacts once it reaches this area right here. If we see another type of sharp low that isolates this whole area right here, we start looking for higher prices again, which would be the low of this daily SIBI right here. So if we keep on seeing sharp lows on the lower time frames, this is when we don't want to start pushing against that. And that's exactly what we talked about in the previous video. We don't want to trade into strong lows. That's when we simply focus on levels that are on the upside. Here, what comes to the daily time frame as well as the lower time frame. What comes to the lower time frame levels? In this type of case, they would be simply looking for a market maker model, let's say on a 15-minute time frame. And everything inside right here, everything below this level right here would be counted as internal liquidity on the lower time frames. And once we reach out higher again, we are on the external liquidity side. So after looking for longs in this leg right here on the lower time frames, what do we do once price reaches higher right here outside of the internal liquidity? We are simply stuck on the sidelines because again, we are pushing into opposing bearish range right here, meaning that drop lower can happen at any time. Drop lower can happen at absolutely any time here. This is exactly why we don't want to pick the top. We want to engage into the markets once price gives another strong low and we have another internal range to play in, targeting another daily highs right here. Similar to here. So what that means is that we simply keep on pushing higher, looking for longs only, trading to the upside till price eventually, let's say, reaches into another opposing PD array, and we see one of the strong lows broken. Once that happens, from here our focus starts going on the bearish side again, especially after price gives a rejection of a bearish PDA, breaking some lows again. This means that we are shifting into a bearish delivery right here. And from that point, we start doing the same exact thing, but on the downside. But this time, we are not only focusing on the internal liquidity, because here we are pushing to the upside here. In this case, we are pushing against the daily flow, the daily direction, which is squarely pointing at the downside. However, in this case, we are trading with daily time frame, we are trading with daily moment and with daily direction. What that means, we don't only swing for the internal liquidity targets, we also swing for the bigger levels because we are trading from a daily PDA with daily time frame momentum, and we are looking for a lot bigger moves. So that's that for this time. I hope I answered some questions.